Hi everybody, welcome to Chapter 24, where we're going to learn about measuring domestic output and national income. So remember the circular flow diagram. Here's a different view of it, but it's all the same stuff. So you've got, your money going around the outside and stuff going around the inside. Stuff is counterclockwise, money is clockwise, as long as you have the squares set up the same way that we always have. Now, the primary thing that we're going to do here is learn about how we actually account for the economy's performance. And as I think GDP is the big measure, but we call the calculation of this national income accounting. And primarily, it's done by the Bureau of Economic Analysis. And we're going to use this information in all sorts of ways to decide how healthy the economy is. To track our long-run course. And then, of course, we use this data in order to make policy. And for a lot of people, this is the most important part. Because if we don't have good data, then clearly whatever policies we're going to make aren't going to be very good either. So GDP is the major one. It is the measure of aggregate output. So it's all the output that we create, all of the stuff that we make, all of the goods, plus all of the services. But it's a monetary measure. So we're going to do this by measuring the dollar value of everything. It is important that we do not count the same thing multiple times. That's going to be super important. So primarily, like once a car is sold the first time, then it never gets counted again. So when you buy a used car, nothing was produced. You just traded basically money, which wasn't produced, and a car, which has already been counted. So there's no productive value to that trade, so it doesn't go into GDP. Now, there is some production from the service side if you buy that car from a dealer. So the dealer gets the car on a trade or something, and then they clean it up and they maybe they fix some things or whatever. So they will provide a service, and the portion of the service which turns out to be the difference between what they paid for the car, what they sell the car for minus what they paid, that is GDP because it's service on the used car side of things. But for the most part, when it comes to secondhand goods, they get ignored. Likewise, we ignore intermediate goods. So the tires that go into this car that get purchased by Ford from Goodyear, okay, so Ford buys tires from Goodyear. Goodyear does not count. That sale does not count into GDP because the tires are going to get counted as production when the ultimate car that the tires wind up on gets sold, okay? So there's a couple different ways we can do this. We can either take the market value of the final goods, or we can take the value that's added at each stage. This, of course, gets a little bit more complex. So let's look at it from the value-added perspective of making this coat. So the final coat is sold for $350. Okay. Now imagine that we count the production of the wool that comes from the rancher. So he raises the sheep, he sells the wool for 120 to a wool producer who then makes it into cloth and sells it for 180, and then a coat manufacturer who makes the cloth into a coat, and then they sell it to somebody who, like a brand label manager or something, and then this is the actual store. So if you count each of those, then it would look like we produced $1,140 when really all we produced was $350. So by using the method where we count the final sale, we get $350, or by subtracting and only paying attention to the value that gets added. So 120 plus 60 plus 40, 50, 80 also equals $350. So this one's a little bit more complex than this one, which is why we usually do it that way. Now, financial transactions are going to get excluded. So when we buy stocks and bonds, typically we're buying that stock from somebody else, so it is not productive. Most of Wall Street, Wall Street doesn't like to admit this, but financial transactions don't produce anything, so we don't count that. We also don't count public transfer payments, so things like Social Security, welfare, private transfer payments. So when your grandma, gives you $25 in cash for your birthday, that does not That does not count in the stocks that I already referred to. And then obviously our secondhand sales that we already referred to too. So we've got the different ways that we can arrive at GDP. We can either look at the income approach, which basically is where we count up all of the income that people make. Okay? So if money is spent, if something is produced, a good or service, then it's sold, it's going to wind up in somebody's pocket as income. Money is going to wind up in somebody's pocket as income. So we can count all of the money that everybody makes. The other thing we can do is count up all of the money that everybody spends, right? So at that point, we can arrive at the same number. So here are two approaches. We can take household consumption plus investment by businesses, which is like business consumption, plus everything that the government spends, plus everything that foreigners spend. And that will give us the expenditures output approach, right? That'll give us the GDP based on expenditures. Or we can take the wages that everybody earns, plus the rent that owners of land get, plus the interest that owners of capital get, plus the profits, and then some statistical adjustments, and we will wind up in the same place. The two numbers will be equal, and they will both equal GDP. So, expenditures approach, that's where we're going to spend the majority of our time. So really pay attention to this. So we have C, which is the abbreviation for personal consumption. It includes durable and non-durable goods. Durable goods have a life of 3 years or more. Non-durable, less than 3 years. So this would be like refrigerators and cars and things. Non-durable consumer goods would be clothing and food and gasoline, that kind of stuff. Then we also have consumer expenditures for services. So your accountant, you pay your accountant to do your taxes, that kind of thing. That goes into C. And then we have both domestic and foreign goods that get produced. That's going to all count as C. Then we have IG. So this is gross investment. Okay, so that's what the IG stands for, gross investment. But we're talking about private, domestic investment, so not foreign investment, not government investment. This is basically when businesses buy equipment. They buy machinery, they buy tools, all construction, so when we build houses, when we build buildings, that kind of thing. And then a change in inventory. So if inventories rise, then that means that we made more stuff than we sold. Even though it hasn't been sold yet, it was produced. It's sitting in a warehouse someplace waiting to get sold, but we have to pay attention to that because it hasn't yet shown up as either a good that was sold the final time or as income for somebody. So that change in inventory counts as domestic investment. Then the creation of new capital assets comes in, and then non-investment transactions are excluded. So when businesses do things that are not for investment, they are excluded. So let's take a look at what gross investment is. So basically, gross investment is everything that businesses spend. That's what gross investment is. Now, depreciation, remember, is when things wear out. Okay, so remember that you start off on January 1st, there's a certain amount of stuff, right? Businesses have a certain amount of machinery, they have a certain amount of inventory, they have a certain amount of stuff that they own. Over the course of the year, that becomes less valuable because it's wearing out or it disappears, it gets sold, whatever. So we call all of that, well, let's not count on what's sold, that's an inventory change. But let's definitely pay attention to how the stock of capital wears out. We call that depreciation. So, of course, businesses are constantly buying new things or fixing old things, and that is gross investment. When gross investment is larger than depreciation, the difference, so this right here is depreciation, this right here is gross investment, and the difference is net investment. So when net investment is positive, then you see that we have an increase in the stock of capital. So this orange block at the end of the year is bigger than this orange block at the beginning of the year, which means that our gross investment was positive our net investment was positive because gross investment was bigger than depreciation. Now, of course, it's possible that depreciation would be bigger. That would mean basically that the company was sort of using its own stuff and delaying rather than building back up. They might do that in a time of recession or something like that. The next element is G, so these are government purchases, and this is basically the government behaves very similarly to to businesses and consumers together. So they buy goods and services. So the government just contracts with private companies just like any other company for goods and services. Additionally, they own capital. So you always hear about infrastructure, buildings and roads and schools and airports and that kind of thing. Those are publicly owned capital, and they can be invested in just like anything else. And once again, we're going to exclude transfer payments. So remember, transfer payments are money from the government for which no direct work is done in exchange. And then we pay attention to exports. So we add what we export, but we subtract what we import. So basically, we look at how much money gets spent. We have to subtract everything, all the dollars that are spent on stuff that was built elsewhere, because that's not our production, right? It comes from someplace else. Some other country counted GDP, or it counted this item in their GDP, and it would be the same as double counting from the world perspective if we counted those imports. And an import economy would look like it was producing a lot when really it wasn't. So this you got to pay attention to. This is the expenditures approach to GDP. C, consumer purchases plus gross domestic investment plus government plus net exports. Now, of course, in the United States, we know that lately this number has been positive or negative. Pause and think about it. So exports are generally smaller than imports. So this is a negative number, and it's therefore decreasing GDP lately in the United States. Not always, but it has been pretty much in your lifetime. So here is the U.S. economy in 2009. We've got the two different approaches, the expenditures approach and the income approach, and you can see that they add up the same way. Income approach is a little bit more complex. So here you've got some GDP if you want to compare. But for the most part, you can see that the United States GDP is very high. So the income approach looks at compensation, rent, interest, proprietor's income, corporate profit. So you should probably pause and take a look at each of these things. And then here is the rest of it. It's a little more complicated, which is why I don't use a lot of it. But you can read this. So the chapter will tell you what all of these things are from a definitional perspective. So you can pause now and look up these words if you don't know what they mean. But do have a decent understanding of that. And here is the whopper. This is the full circular flow diagram. And you're not going to have to know this specifically, but I do want you to go through and read it. Because what it does is it shows you how the two approaches make sense together. So the green is counting from the income approach, and the orange is counting from the expenditures approach. And you can see how they interact and wind up basically being, they're counting the same thing. So GDP is a dollar measure of production. We use dollar values, but that creates problems because what we wind up doing is collecting nominal GDP. We wind up collecting nominal GDP, but we want real GDP. So real GDP reflects changes in price. Okay, when you hear the word real, you think adjusted for inflation. Okay, so real means adjusted for inflation. Whereas nominal is the prevailing price. It's today's dollars. But if we want to compare GDP this year to GDP next year, we're going to have different price levels because of inflation next year from this year. So we have to somehow control for that. The way we control is by creating a price index. And for the price index, we do our market basket. And the market basket is just the same thing every year. So let's say in the world of groceries, we do bread, a pound of ground beef, and then milk. Okay, and this year bread costs $2, ground beef costs $5, and milk costs $3. So our market basket is $10. Okay, So we then choose this year, year 1, as our base year. Okay, so 10 is the base year. Now let's say a year from now, we go back and we do the same thing, and in the next year, bread costs $4, and beef costs $5, and milk costs $5. Well, that means that we're buying the same amount of stuff, but we're paying $14. Okay, so we take 14, we divide by 10, and that gives us 1.4 times 100, which is 140. So our price index then is 140 in this situation. Okay, so now that we have our price index, we can figure out what our nominal GDP would be. I'm sorry, we can figure out what our real GDP is by taking our nominal GDP in that year. So let's say that our nominal GDP of that year was, I don't know, 14 billion, and then just to keep the math simple, and then our price index is 140, so then our real GDP was 10 billion. Okay, which obviously you can see how the math works out sort of conveniently because I use the same numbers. But that's sort of the idea behind having a price index. So here we do the same thing with pizza. So you can see that our price index goes from 100 to 200 because our price doubles, and then it goes up to 250. So you can just do the same math. You'll notice that year 1 is the base. So the base will always be 100, right? Because that's going to be, if it's 5 over 5 times 100, the base year, the nominal, and the real are always the same definitionally. So your base year is always going to be 100. So if you saw, 80, 100, 200, 250, and the question was, what's the base year? Then you would know that it was this, because it's always going to be 100. Now what we can do is look at our output, okay, and we take our output, we multiply by price, and that gives us our nominal GDP. And then all we have to do is divide by our price index, and that gives us real GDP. In the base year, they're the same, so that shouldn't surprise us. Okay, so then we're going to take 140 divided by 200, and that's going to give us a real GDP of 70, which makes sense because we produced a little bit more, so our GDP should be a little bit more, and so on. So you can pause the video now and fill in these bubbles by doing the math yourself. So GDP, unfortunately, does have some shortcomings, okay? So lots of things that we do are non-market activities. So let's say you have a garden in your backyard and you grow food. So if you make a pound of potatoes and then you don't buy a pound of potatoes at the grocery store, if you bought it at the grocery store, then that $5 would show up in GDP because Schnucks would report that income. But instead, you grow it yourself. You don't tell anybody that you grew it. So that's a non-market activity. It's totally legal and everything. We're not talking about the black market, but it doesn't show up. Then there's the value of leisure. So let's say, my skills and talents could produce, $1 million worth of GDP, but I like to take time off. I don't want to work that hard, and I don't need to make that much money in order to be happy. So I value leisure, okay? But that doesn't show up in GDP. You can look at something like, the personal computer. So the personal computer right now, this MacBook that I'm using to make this video is actually cheaper than the Apple IIc that I got when I was in 4th grade, even in today's dollars, right? So nominal, that computer was a couple grand in 1980 something. So you can imagine what that would be in today's dollars. Fabulously, fabulously expensive. And clearly the MacBook that I'm using right now is a heck of a lot better. But that improved quality does not show up in GDP. In fact, it looks in many ways like the computers are contributing less to GDP based on the decrease in price. Then there's the underground economy. So this is all the criminal activity, which is productive. It's not productive for good purposes, but it is productive. But it doesn't count in GDP because nobody's declaring that for their tax returns. GDP tends not to focus on the environment. In fact, you can argue that, by increasing GDP, we're increasing a lot of things that are bad for the environment, because usually GDP is pretty resource intensive. The composition and the distribution of the output, like just because we're making it doesn't mean it's good. If Hurricane Katrina, or when Hurricane Katrina struck, obviously there was a big dip to GDP because, of all the problems. But then as we rebuild New Orleans, that's a huge boon because all that construction goes into GDP, right? If everybody got sick, so everybody gets the flu and everybody goes to the doctors, well, that's creating a lot of GDP. Especially for children who aren't producing anything, and yet parents are then shelling out all that money for healthcare, so that's upping GDP. But clearly, I think we'd all prefer to not get sick. And then there's the non-economic sources of well-being as well, similar to leisure and things like that. So the underground economy, you can see different parts of the world where the underground economy is big and small. In the United States, we do a pretty good job of keeping most things above board. So how do we come up with this? Well, here's some interesting places. Those of you who like economics and think you might want to study it, these are the places that you can get jobs, some of them as an economist. And then obviously for investment, we're going to have different sources, and government as well. So these are just different sources. These are all names that, if you like this stuff, you can pay attention to them and start to learn what they do. And that will do it for Chapter 24. Thank you very much, gentlemen.